Hi folks, and welcome back to Meaningful Money. Okay, I'm high above Porthgwarra Cove, which is just down there, and it's a beautiful June morning, so a great day to be out filming, hence the shorts, first time this year, so count yourself lucky that you chose to watch this one. We're going to be talking about shares this time. We've talked about gilts and corporate bonds, talked about cash. We're sort of tidying up the asset classes. I did these videos yonks ago, so this is an update to actually one of my favorites, which is episode number 31, talking about shares. So before we get into that, let me thank my friends down here in the bottom right, which is Seven Investment Management, who continue to sponsor me here on Meaningful Money, for which I'm really, really grateful. Now, most people know or have some idea of what a share is. Essentially, a share is a tiny slice of a company. So a big company will be divided into, very often hundreds of millions of shares, or certainly tens of millions. And if you own a share, you've got a very, very, very small slice of that company. Shares are sometimes called stocks. They're sometimes called equities. You'll hear me say that quite a bit. And that word equity infers ownership, just like you have equity in your home. So owning shares, it confers certain rights on you as a part owner of a company. Firstly, you can vote on things, resolutions pertaining to the company that you own. You have a right as a shareholder to vote on things which affect your company. If the company makes a profit, it might decide to distribute some of that profit to its owners, and so you would get what's called a dividend, an income from owning your share. But share ownership doesn't mean that you can walk in and decide that I'm going to run the company. If you happen to own, Vodafone shares, you can't walk into the boardroom of Vodafone and decide that you're going to run that company your way. No, you as a shareholder, and with all the other shareholders, would employ a board of directors, and they would then, employ staff and everything. So you sort of delegate the running, the management of the company to your board of directors and the chief exec. Now, a share has a value, which is why we're talking about it as an asset class, something you can invest in. But how you value a share is complex. A company will have certain assets. Maybe it's got, buildings, office buildings, or retail stores that it owns, and so it's got property. It might have other assets like stock. If it's a shop, you're selling something. So those are assets. It will also have liabilities. It might have pensions to pay. It certainly has staff to pay. It might have some loans that it has to service. So any company will have assets and liabilities. And so you could say, well, that surely then is the way to value a company. It's basically the assets less the liabilities, and therefore my shareholding, if I hold 1% of the shares in a company, then you do that sum, 1% of that is mine. Well, it's not that simple, as you may have expected, because like any kind of investment, a share is only worth what somebody is prepared to buy it for. And so you get various other factors in play. Supply and demand is a big one. Sentiment is probably the biggest, because if a company looks as if it might do well in the future, it's making a profit now, it looks like its profits might go up in future, more people will want to buy that share. That'll push the price up. If the company looks as if it's going to struggle in the future, or is struggling now, people will want to sell those shares, and there'll be more sellers than buyers, and that will push the price down. So sentiment is a massive factor in how you value shares. Just a couple of other things to say. There's more than one type of shares. Usually if you hold shares in a company, you'll hold ordinary shares. But there are such a thing as preference shares as well, and as the name suggests, they have a sort of slight priority edge over ordinary shares. You get priority on the dividend if there is a profit made, and if the company has to be wound up and closed, and then everything divided up, you would also get priority on any money due to the shareholders as well. Shares, though, are a really important part of any portfolio. They're essential, really. They're not just important. That would be to underplay them. Anybody who wants to make some money over the long term by investing will hold shares in some form or other. But as you can imagine, there's tons of different types of companies. There's big companies, small companies, well-established companies, and new companies. Thriving companies and struggling companies. There's companies all over the world. There are companies which do produce a dividend. There are companies which are not making any profit at the moment but hope to in future. It's a really, really broad church. And so it's a useful diversifier in any portfolio. It behaves different to some of the other things we've talked about. Shares behave different to gilts and corporate bonds for the most part, for example. And so holding shares is really important. How you do so, of course, most investors will either hold a few individual shares, Vodafone, BP, Lloyds or whatever, but most people hold them in funds, which we've talked about before. So that's really how shares work and how useful they are in a portfolio. I hope that's useful. As ever, leave me any questions under the video here if you want to. I'll do my best to answer them. Next time we're going to look at the next asset class, which is property. So from Porthgwarra, thank you for watching and I'll see you next time.